Hello, everyone, and welcome to the Confederation Club of Waterloo's April webinar. Our goal is to bring Canadian digital politics and today economics to life. My name is Barb Shackleton, and I'm the Confederation Club Director of Marketing and your host for today's webinar. I will also be joined by Jerry Zhang, current president of Confederation Club, and Stephen Cage, our Speakers Committee Chair. Before we dive in, just a few items of interest to mention. We are recording this webinar, so you'll be able to participate and watch and listen to it on our website, confederationclub.ca. And we also plan to poll the audience, and we encourage you to respond. Your responses are completely anonymous, and we appreciate your input. If you wish to submit a question, please pop it into the chat question box, and Stephen Cage, our Speakers Committee Chair, will moderate and answer your questions if we have time. So please ensure that your questions are appropriate. Before we get started, just like to provide a little bit of a background for those of you who may or may not know about Confederation Club. Our club was founded in 1976 with Joe Clark as our first speaker, about a month before he became party leader. Our speakers have included past conservative and progressive conservative prime ministers, Brian Mulroney, Kim Campbell, and Stephen Harper. Our impressive speakers list from the past 45 years is available at our website on confederationclub.ca. And without further ado, I will now ask Jerry Zhang, President of Confederation Club, to introduce our guest speaker. Jerry, take it away.
Good evening, everybody. I'd like to welcome all the attendees online. We have more than close to 40 people online right now. And thank you for joining our webinar. So tonight, our speaker is Sal Guatieri. So Sal has more than 2 decades of experience as a microeconomist. So Sal joined the BMO Financial Group since 1994. So his main responsibility include analyzing and forecasting the US and the Canadian economies, interest rates, and exchange rates. So he contributes to various publications, gave economic presentations, and is a regular commentator on economic and financial trends to the media. So prior to joining BMO, Sal worked at the Bank of Canada as an economist in the research department, contributing to the staff's quarterly economic projection, and in the international department, analyzing foreign exchange markets. And Sal received his master's degree in economics from Queen's University in 1990. And I should mention, Sal is old friend of Confederation Club. As far as I remember, this is probably Sal, your 4th or 5th time to give us a very timely update on the economy. As you can see on the screen, that was Sal. That was last time you were here. Was June for our June 2019 launching in person. So we always looking forward to your update. After about 2 years, and especially this year, we live in such a unsettling time, and with all this turmoil, I think our members and friends we're looking forward to learn from your expertise on the economy, from your perspective. What is the look in front of us in the future? So Sal, without further ado, take it away. Welcome to Confederation Club.
Well, thank you, Jerry. And good evening, everyone. I hope you're all doing well in these very trying times. It may sound a bit odd if I sound a little optimistic tonight, given that Ontario just reported a record number of caseloads and seems to be pondering more aggressive lockdowns. But we believe if we can just get through the next couple of months, Canada's economy is probably on track for its best year in nearly half a century. Of course, now that it's clear we lost the first leg of the race against the variants, so we will need to pick up our socks and get to the finish line. Barb, if you could advance to the first slide, please.
I guess
Jerry,
Barb maybe have some technical difficulty. Barb, can you talk? Do you want me to maybe drive the slides?
Yeah, just give me 1 second. I will. Share this. My apologies.
No problem.
Can you see that?
No, Barb.
Yeah.
Not yet.
Can't see that slide?
No.
No.
No, I can't either.
Yeah, not.
I don't know why the wrong one's coming up.
There we go.
Here we are.
There we go.
My apologies, gentlemen.
No problem, Barb. Barb, if you could advance to that first slide. Thank you. Great. So clearly, the biggest concern now is this third wave of the virus for Canada. We've already seen it hit Europe as well. That is probably the biggest risk to the economic outlook at the moment. We've got new restrictions in effect. I mean, the good news, as you can see from that chart, though, is the US, which is advanced in its vaccination program, has at least been able to suppress the recent surge in caseloads. And I presume Canada will get there fairly soon as well. The other good news, as we'll see, is that Canada's economy showed surprising resilience to that second wave of caseloads and restrictions through the winter. And we'll talk a bit about that very soon. Barb, the next slide, please. So it really comes down to, you know, can we beat the variants with the vaccine rollout? There's three countries at the top of your chart there that clearly have. I mean, Israel, the UK, and US. The UK is a remarkable story. It's reduced its caseloads and death rates by, I think, 90% in the past month or so because of its rapid rollout of vaccines. You know, we're kind of in the middle of the pack, at least compared to the European countries. But the fact of the matter is the vaccine program in Canada is starting to accelerate now as more supply comes on stream. I think we're maybe 2 months behind the US in this race. They'll probably reach mass immunity by early summer, maybe even late spring. I think we're going to be a couple months behind, but you know, if you look back 6 months or so, no one was talking about, you know, achieving mass immunity by this summer. So in that context, it is still, you know, relatively optimistic outlook. It looks quite certain that Canada will achieve so-called broad population immunity by at least the middle of this summer. And that's where when things will really start rolling along quite nicely. Barb, the next slide, please. Obviously can't come soon enough for a lot of the hard hit sectors for Canada's economy that are still facing pretty significant restrictions. As you can see from that chart on the left of your screen, you know, few people are traveling by plane these days. Accommodation and food still hit very hard. As you can see, the trends in the last month or two are not very encouraging because most have started to head south again due to the latest restrictions. And now, of course, in response to the third wave of restrictions across much of the country, apart from Atlantic Canada. So the trends are not going very well. I mean, you can notice on that one chart, though, that people back in the fall, before the second wave of the virus, were starting to head back to clothing stores. They were perhaps eyeing going back to the office, needing new clothes. And we've taken a bit of a detour since then. But again, these trends can change very quickly once we get this vaccine program rolling out more quickly. And the bigger story is that for Canada, these hard hit sectors still account for less than 5% of our economy, our GDP. So, they're still operating 40, 50, 60% below capacity in some cases, or below normal levels. But that a lot of that is being offset by the rest of the economy, the other 95% of the economy, in particular, some industries that are doing quite well and are almost back to normal levels of activity, pre-virus levels. So manufacturing, construction, for example, professional services. So that's kind of what's holding our economy up so far. Barb, the next slide, please. And much to our surprise, the economy did not contract in the winter. In fact, our GDP grew close to 10% annualized in the fourth quarter of this year, and it looks like it will grow about 6% annualized in the first quarter of the year before slowing a bit in the second quarter, the current quarter, in response to these new restrictions. That's a much better performance than I think anyone was anticipating. For a while there, we did pencil in an outright contraction for Canada's economy at the turn of the year. But again, it's shown pretty remarkable resilience in response to that second wave of the virus and restrictions. So we're now operating about 3% below pre-virus levels. We've made a lot of progress from the shutdowns of a year ago when GDP collapsed by 18%. So a lot of progress there. And again, we think the outlook is relatively good once we get by this quarter, the next couple of months in particular. We're all itching to get out there and dine and travel and see movies in theaters once again. A whole year of pent-up demand just ready to unleash, as the Americans are doing right now, and the British are as well. So that's going to support our economy at least for the next year. We're going to benefit because the rest of the world is coming back, in particular, our major trading partner, the US. And of course, as we'll talk about soon, plenty of fiscal policy support on both sides of the border. And to top things off, there's just a tremendous amount of savings piled up in household savings accounts, checking accounts, on average through the pandemic, just simply because we've been constrained as to where we can shop and because of the government income support programs. Barb, the next slide, please. So starting with south of the border, the amount of fiscal stimulus that the US government is pumping into the US economy is simply something we've never seen in our lifetimes. But you probably have to go back to the post-World War II period to see this amount of government stimulus stoking an economy. There's some figures on your screen there. You're talking, those first two so-called rescue plans passed through Congress in the last 3 months, equivalent to about 13% of the US economy. It's just an enormous amount of stimulus, even far in excess of what we saw during the CARES Act rescue plan of a year ago during the shutdowns and the start of the pandemic. And now the president is proposing upwards of $2 trillion of infrastructure infrastructure spending, and spending in some other areas as well: childcare, education, affordable housing, green energy policies as well. Now, we won't get the U.S. economy won't get the same punch from those proposals as it has already now from these two rescue plans, because that spending will be spread out over many years, several years, and largely will be offset by measures to finance that increase in spending, in particular an increase in corporate income tax rates in the U.S. But overall, I mean, there's just a tremendous amount of stimulus in the US. And that is why we're seeing some of these data just as recently as this morning. Retail sales in the US up 10% in March, in 1 month, simply because it looks like personal income will have risen a record 23% last month because of those rebate checks and some other income support programs in the US. So from our lens, it looks like the US economy is on track to grow about 6.5% this year. That will be the best rate of growth in about 4 decades for our major trading partner. Barb, the next slide, please. And as come Monday with the federal budget, we're looking forward another boatload of spending and stimulus on this side of the border as well. It was basically flagged to us in the fall economic statement that the government is proposing anywhere from $70 to $100 billion of additional spending to support the recovery. We're kind of past the rescue stage now, but just to accelerate job growth and get our unemployment rate down faster. And that's on top of all the other stimulus and measures that have been put in place in the past year to cushion the blow from the pandemic. And in particular, a lot of the support programs, not just for workers, but for businesses as well. The wage subsidies, the commercial rent assistance, that's kept a lot of businesses in Canada afloat. And so far, a plan to continue right into the summer. It's quite possible in this budget, we'll see those programs extended even further out. Our general assumption is that those support programs probably will not start to wind down until we're well out of the woods, maybe till late this year. Now, of course, a lot of this comes at the cost of digging a pretty deep fiscal hole, on the order of a 17% budget deficit last year and through the current fiscal year, and a pretty sizable deficit, I believe, will be announced on Monday for the coming year as well. Importantly, it will be important for the government to put some fiscal guardrails in place, at least some kind of fiscal anchor, whether it's a declining debt to GDP ratio or a stabilizing debt service burden. The government's not spending a whole lot of its revenue on its debt payments right now, only about 6 or 7%. Remember, back in the 90s, it was spending about 1/3 of its revenue on debt payments because interest rates were so much higher then and debts were higher relative to the size of the economy. We're not there yet, but the government definitely has to put in place some kind of plan to stabilize the run-up of the debt relative to growth in our economy. So hopefully we'll see something along those lines, and that would be enough to ward off possible downgrades of our credit rating. Fitch has already downgraded us and warned of potential further downgrades. We haven't had the big players, the S&Ps, Moody's, they still have a AAA credit rating for Canada, but hopefully the government will put in enough measures to at least keep our fiscal house on a sustainable course over the longer term. Barb, the next slide, please. Now, all that government spending and income support has just done wonders for cushioning the blow of this pandemic for our economy. And really, you can see it in these two charts here. Not only were the government income support programs enough to offset the lost worker earnings during the pandemic, it actually boosted those earnings by a factor of three times, as you can see from the chart on the left-hand side there. So it more than filled the income hole, much more. And as a result, and very unusually during a recession, we saw a huge spike in household income across Canada, similarly in the US. Very unusual during a recession to see household income jump 15% in the past year, but that's exactly what happened through the shutdowns and through the initial stages of the pandemic last year because of the tremendous income support programs. Barb, the next slide, please. And we haven't spent all that income. In fact, we've spent just a fraction of it, as you can see in this chart here. The amount of savings that Canadian households in aggregate have piled up in the past year is just enormous. It's by a factor of about $180 billion over the 4 quarters, in excess of what we normally save over a 1-year period. That's equivalent to about 4 years worth of normal consumer spending increases. It's not to say that all those savings will be plowed into vacations and restaurant outings and movie tickets. A lot of it will continue to be saved or used to pay down debt, and that will be very helpful for many Canadian households, or used to invest in assets, the stock market or the housing market. But a good chunk of it will be used to finance the pent-up demand that will be unleashed over the next 1 to 2 years in Canada. Barb, the next slide, please. And we've already, really rebounded our spending on goods, retail goods in particular. They're fully back to pre-virus levels. In fact, more than fully back. We've been shopping online at record rates, buying a lot of recreational goods, housing-related goods, furniture, appliances, for example. Where we've cut back, of course, are those personal care services, entertainment, travel, a lot of the services. So overall, consumer spending is still a bit below pre-virus levels, but not so for retail sales in Canada. Barb, the next slide, please. And much like, although albeit to a lesser extent, businesses are sitting on a tremendous amount of excess cash at the moment. Unlike for households, though, most of that cash, we believe, is for precautionary reasons. A lot of corporations simply took advantage of very generous government borrowing programs, in some cases forgivable loans, to build up their cash balances in the event that the pandemic got even worse. So a lot of those loans would just simply be paid back. They won't be plowed into new investment, but some of that money will be used for investment. We're already seeing a nice upswing in business spending on machinery and equipment in Canada, much like in the US. Still got a ways to go for commercial construction. The office and retail sectors are still a lot of uncertainty about how those 2 sectors will play out even after the pandemic, because of the shift towards remote work, for example, and the shift towards online purchases. But for the most part, business investment is starting to come back in Canada. Barb, the next slide, please. And our economic recovery has proceeded well enough, in fact, better than I think most people would have anticipated, better than we anticipated, to the point where our unemployment rate now is down from north of 13% during the peak a year ago to 7.5%. We still have a couple of percentage points to go to get back to early last year levels, pre-virus levels. Might take another year or so to do that. But overall, I mean, employment initially was down 3 million during the shutdowns of last spring. We've pared those losses down to 300,000, about 300,000. So we've made a lot of progress on that front. It's still those hard hit sectors, accommodation, food services, where we're seeing the bulk of the job losses. And unfortunately, we'll probably see another wave of losses in those areas, restaurants, bars, hotels this month and maybe next month because of the new restrictions. But come the summer, and assuming a successful and accelerated vaccine rollout, things should be hopping once again by that time. And who knows, by the summer, we might have recouped all of those lost jobs. Barb, the next slide, please. A really quick or faster than expected recovery, not just in Canada, but also in the US, has clearly raised concerns about the inflation outlook. We're not to the point yet where we're losing sleep over the matter. We still think unemployment is high enough, there's enough excess capacity in our economy to keep prices down. Certainly, a lot of people are still worried about losing their jobs, not just because of the pandemic, but because of getting outsourced to an algorithm or a robot, so-called automation anxiety. Globalization is still keeping prices for competitive reasons in check as well. So we don't believe inflation will get too out of hand, but clearly we're going to see inflation pick up over the next year. And there is a risk if policymakers overdo it and don't take back all the stimulus in a timely fashion, that we do see a problem with inflation. As you can see from this chart, central banks, both sides of the border, again, just ramping up the money supply to get the economy hopping on a sustained basis. But it hasn't translated into higher inflation yet. But certainly, if that money growth doesn't slow over the next 1 to 2 years, that could be a problem. We're also seeing costs going up on a wide range of industries because of the acceleration of many commodity prices, lumber prices more than doubling in the past year, for example. Just a broad range of commodities have gone up. That's actually good news for Canada because a lot of our economy depends on resources, but it's not so great for companies that are facing higher costs and eventually consumers who will probably see those costs passed along to them. So there are concerns on that front, and definitely we'll have to keep a close eye on the inflation ball over the next 1 year, especially when the unemployment rates get lower. Barb, the next slide, please. Because we expect inflation to remain relatively well behaved, we think policy rates can remain on hold for probably another couple of years. This is actually, our view is actually less than what the Fed and even the Bank of Canada, we believe, is currently planning. They seem to want to keep rates near zero for even longer. And remember, the Fed is actually aiming to overshoot its inflation target for a period of time just to compensate for past undershooting. But for the most part, we think as long as inflation remains relatively well behaved and drifts up only modestly in the next year, both central banks, Bank Canada and Fed, will be able to keep policy rates low, steady for the next couple of years. It does mean that longer term rates will probably continue to drift higher. They've already spiked up significantly, 70 basis points just this year, again, both in the US and Canada. We expect more subdued increases over the next year if inflation remains well behaved and central banks remain on hold. And if that's the case, I mean, those long-term interest rates will continue to remain at historically low levels, again, providing support to the economic recovery. Barb, the next slide, please. And of course, providing plenty of support to our frenetic housing market. Now, I should just say Canada's housing market is frenetic. We're really seeing this phenomena on a global basis now. It's pretty well almost every country is seeing a spike in home prices and overheated demand because of such low interest rates. But Canada just seems to have upped the ante a bit more than any other country. We did not have a chance to update this slide for the March home sales results that were out just this morning. But just take all these numbers and add a few percentage points to them, and you'll get a picture of what the March numbers look like. Home sales across Canada up 76% in the past year in March. Benchmark home prices up 20% now in the past year. And all those numbers that you see on the right-hand side of your chart, again, you could add about 3 or 4 percentage points to them. If you're wondering where Kitchener-Waterloo stands there, well, they're off the chart. Prices are up 33% now in the past year in the Kitchener and Waterloo region benchmark home prices. Again, topping the national average. The biggest price increases, though, are not just in cities. They're actually across many smaller towns and rural regions, especially across Ontario. And of course, cottage country has just gone berserk in the past year. We're seeing benchmark price increases of 40, 50% in some of those regions. A lot of things driving the acceleration of prices. It's not healthy. It's not sustainable in the long run. Our only hope is that the market cools down on its own, just simply because prices are rising so quickly. That'll bring more sellers into the market and fewer buyers. Or policy measures, and we could see some announced in the federal budget on Monday. Policy measures could shift a little bit tighter as well. OSFI already proposing to raise the minimum qualifying rate on uninsured mortgages to 5.25%, which will cool home demand, especially in some of the pricier regions, a little bit. It generally means about a 4 or 5% loss of buying power at that higher qualifying rate. So that could cool the market, but the only thing that's really going to change the psychology of the market now is either an interest rate increase, which is not in the cards, or maybe the Bank of Canada coming out and saying, listen, don't expect interest rates to stay low for forever or for many years. At some point, we will be raising rates, because right now, so many people seem to be buying on the assumption that interest rates will stay low forever. And as a consequence, they just fear missing out of future price gains. So they're rushing into the market at almost any price. These sellers markets, it's not a Toronto, Vancouver story anymore. That was 2016, 2017. This is basically right across the country and in small cities and towns where normally you don't think that, they would have supply issues, but demand is so frenetic that prices are just escalating right across the country in Canada. So a possibility of a correction, yeah, but hopefully things will cool down soon. Some of this shift is being driven by the teleworkers. People, I guess, they have nice bosses who will allow them to work from, 2 or 3 hours drive from the main office, 4, maybe even 5 days a week. I'm not so sure every boss will be that nice or accommodating. And, even 1 day a week, if you have to drive in with a 3-hour commute, could be quite grueling. So we might actually see teleworkers reverse their reverse course a little bit over the next couple of years, but still a big question mark as to how much of remote working will actually stick. We think a portion will, but still a lot of uncertainty there. Barb, if you could shift to the next slide, please. But fundamentally, the main factor, the main driver of Canada's housing market and other housing markets now for more than a decade has been the younger generation, the millennials. The older millennials now moving up, raising families, wanting more space, bigger properties, backyards for their kids. And the younger millennials now buying their first home. And as you can see from this chart, that first-time home buying age segment of 25 to 34-year-olds, it's still growing at a pretty good rate and will continue to do so for several more years. So that they're going to continue to drive the housing market over the next couple of years, along with almost certainly a rebound in international migration, because net migration in Canada took about a 1/2 hit last year during the pandemic. Now that federal government has raised its targets, once we're past the pandemic, we should see international migration coming back to Canada, also supporting our housing market. And to top things off, we've got this intergenerational wealth transfer. Baby boomers passing on some of their wealth to their kids, or at least helping them get into the market by financing their down payments. So that's adding a juice to the market as well. We don't expect the housing market to cool down significantly, barring a dramatic shift in policies. So we'll certainly have an eye on that in the federal budget. But hopefully it will just cool down on its own over the next few months before things get out of hand. Barb, the next slide, please. So just to wrap things up, we're looking at probably the best year, if things go right, read the course of the pandemic and our vaccine rollout, in about half a century. We are expecting growth in Canada, much like in the US, 6.5% this year, after we contracted 5.5% last year. And we should kind of recover all that lost output by the third quarter or so of this year. Now, not all industries will be recovering that quickly. Those hard hit sectors that we talked about earlier, the restaurants, hotels, travel companies, a lot of personal care, even with an influx of pent up demand, they'll take longer to fully get back on their feet. But overall, for the economy, this should be a really good year if things go right. And at the same time, longer term interest rates, I think most of that upturn is behind us for now. We will see a continued upward drift in long-term rates, but if inflation can remain in check, rates should rise fairly modestly and remain historically low. So the biggest things we worry about now, right at the top of the list, obviously, some strain of this virus that either becomes much more severe, much more lethal, or resistant to the vaccines, or at least the current batch of vaccines. That would be kind of our nightmare scenario. I talked about the inflation risks earlier, something to keep our eye on. I think as long as wage growth remains subdued, and so far it has in both the US and Canada, there's no problem. But if we see wage growth starting to accelerate, that would be a warning sign of broader sustained inflation pressures. We talked about the possibility that Canada's housing market is in a bubble already, or on the cusp of one. If it doesn't cool down, if these 20% and in many regions far in excess of that price gains don't cool down pretty quickly, we could be in trouble and face a material correction in house prices later. And that would have negative impacts on wealth and confidence and the economy. We are getting a bit concerned about the dramatic run up of government debt globally, but also, of course, in Canada, which has kind of led the global pack as far as the fiscal response to the pandemic. Hopefully, we'll hear good things in the budget, where the government at least has a credible plan to put its finances on a more sustainable footing. Maybe not this year because we're not out of the woods, but in future years. And then, of course, I mean, there's always that chance that if interest rates go up, some emerging markets, economies, Brazil, India, Mexico, could face some turbulence. But our overall view is that the risk of an emerging market crisis is still pretty remote, because most countries have built up their foreign exchange reserves. They're not running the same kind of current account deficits as they were in the past. And they've kind of put their banking systems on a much sounder footing than in the past as well. So I think I'll leave it at that, Barb, and we could turn it over to questions.
Well, Sal? Good. Well, thank you, Sal, for your presentation. We're now moving to the question and answer phase of the webinar. Some questions were pre-submitted by Confederation Club members. If attendees would like to ask Sal a question, please send your question through the question and answer function. Please try to keep the question short, no more than 2 to 3 sentences, so we can get through as many questions as possible. And so the first question, and you've actually touched on quite a few of the questions that have been pre-submitted, but how concerned should Canadians be about the size of the government deficit and accumulated debt at all levels?
Yeah, that's a great question, because it's not just the federal government that's piling up the debt. It's a lot of provinces as well that are running budget deficits on the order of 4% of GDP or so, especially the big provinces, Ontario, Quebec, for example. Not on the order of what the federal government racked up last year, 17%, but getting up there. When you add up total government debt, it is rising obviously much faster than the economy is growing. So it's becoming a problem. At the federal level, we now have a federal debt relative to GDP about 50%. So that's up 20 percentage points through the pandemic. We were sitting pretty comfortable before the pandemic relative to other countries. Our federal debt was relatively low. It's now around 50%. It's bound to go a little higher over the next year or so. We're not back to that 67% of GDP that we were at in the mid 90s, where Canada faced a lot of global pressure to get its fiscal house in order. So, I mean, it will be important for the federal government in particular to rein things in over the next few years to at least, at a minimum, keep our debt to GDP ratio on a sustainable footing. You know, the debt is sustainable now because interest rates are so historically low and are likely to stay low for several years to come. So the debt service burden is nowhere near what it was like in the 1990s. But you know, interest rates could go up. We could get a surprise there on the inflation interest rate side. That becomes problematic. So it will be important for all levels of government to get their fiscal house in order once we're out of the pandemic.
Great. Do you think that the upcoming Liberal budget will lessen the capital gains exemption for principal residences?
That's a that's a political hot potato. I don't think many analysts give that much high odds of being implemented. Some kind of tax on the capital gains of a principal residence. Canadians are counting, probably more so than ever because of the run up in values, are counting on their house as kind of part of their retirement nest egg. I don't think they'll take that kindly if we see a tax on the principal residence capital gain. So I would put that at pretty low on the list of potential measures that the government could take to cool the housing market. On our website, we recently put up a publication that lists about 10 measures right across the board. We would probably start with something to at least cool off some of the speculation we perceive is now driving some of these price gains as well. So maybe a tax on home flipping or a foreign buyers vacancy tax, for example, something just to cool things off on that front.
Okay, excellent. And that actually goes right into the next question. Do you consider the current real estate boom a real crisis? And should the government interject? And if so, how?
I think it's bordering on a crisis. Yeah, I just don't think price increases on the order of 30–40% in many regions is healthy for our economy. First of all, we're plowing so much resources into the housing sector, more so than any other advanced country. Close to 10% of our GDP now is kind of driven by housing, relative to a long-term norm of about 6%. So that's not healthy. Devoting all those resources to just keeping a roof over our heads and diverting those resources from perhaps more productive endeavors, investing in new automation, for example. And really, the crux of the matter is we're making our housing market so much less affordable for first-time buyers. And we're also just pushing so many homeowners into racking up a lot of debt, when they move up to a bigger house because prices are escalating so rapidly. So it's not a healthy development. I mean, house prices historically should rise a little faster than family incomes, 2–3% or so, maybe 4 or 5% is okay on a longer term basis, but not 20% nationally and 30 or 40% in many of these regions. Now, across most of Canada, prior to the pandemic, and even now, outside of Toronto, Vancouver, parts of BC, housing was still very affordable. The first time a typical buyer looking at a benchmark property was still spending 20% or less of their income, gross income, on mortgage payments. Very reasonable. But that won't be the case if prices continue to clip along at a 30–40% rate over the next year or so.
Okay, excellent. If households have considerable savings accumulated during the pandemic and considerable pent-up demand, how important is further fiscal stimulus at this time?
Well, stimulus is not important at this time. I mean, it was very important a year ago, 8 months, 6 months ago, even 4 months ago. Yes, it was very important. When our unemployment rate was in the double digits. Not so much now. Right now, yes, that further support is needed. that support and that stimulus, if you call it that, should be targeted at those hard hit sectors that we showed in this presentation, at those workers, those business owners that really need that support. But that doesn't, require racking up a budget deficit of 5, 6, 7% of GDP now. And clearly, the income support programs need to continue for both workers, those hard hit workers, and businesses until we're kind of out of the woods. And we're ready to reopen the economy fully and unleash all this pent up demand. At that time, those businesses will do well. They'll recover on their own. So we don't need the stimulus now. We need some more, a little support, but targeted support.
Excellent. One of the first acts of the new Biden administration was to cancel approval for the Keystone XL pipeline. How significant is this to the Alberta economy?
It is significant. It was a blow to Alberta's oil industry and economy. They were counting on that pipeline expansion, taking another 800,000 barrels of oil down from Alberta to the Gulf Coast refineries. Now, apparently, once we get the Trans Mountain pipeline extension completed, that will absorb that transportation of oil from Alberta and get it at least to Asia. But for now, yeah, it's a bit of a blow. Now, oil consumption has not come roaring back globally because much of the rest of the world is still fighting the pandemic, in particular Europe. But once oil demand comes streaming back by the second half of this year, and Alberta will be able to sell much more oil to the U.S. and the rest of the world, that could become an issue. Much like before the pandemic, when it was having a hard time getting its production down to the Gulf Coast refineries, through rail and truck, but not quick enough to meet all of the production that was coming on stream. So yeah, it's a bit of a blow for Alberta.
Absolutely. A couple of related questions. Given the political situation, will the Bank of Canada and Fed be willing to raise rates when and if inflation becomes a reality? And related, where do you think interest rates will be in 5 years?
Yeah, remember, the Fed actually wants higher inflation to become a reality. It's actually planning to push inflation above its 2% target moderately for a period of time. We don't know how long, maybe 2.5%, maybe a little higher for a year or so. So higher inflation will become a reality. And for Canada, the Bank of Canada clearly wants to get inflation underlying measures more sustainably at the 2% target. We're running just a bit below that right now. So higher inflation will become a reality. The question is, does it become a nightmare though, where we see 3% and then 4% inflation, and the kind of shocks we were seeing back in the 70s and early 80s, where wage cost driven inflation was pretty difficult to get under control just by raising interest rates. It took a pretty big spike in interest rates to eventually suppress inflation, and almost always by generating a recession. So hopefully we won't get to that point. I think central banks have learned enough lessons. Once they see increased signs of inflation pressure, especially in the labor market, they'll start pulling back a little bit, taking their foot off the gas pedal. As far as where interest rates will be 5 years from now, that's the crystal ball gets pretty foggy that far out. But I would say we're probably looking at policy rates in Canada about 1.5 percentage points higher than the near zero rates right now. A little more in the U.S. Longer term interest rates, the benchmark Canada yields, which are now about 1.5%, probably just under 3% or so 5 years from now. Historically, still relatively low, but not as low as they are now, and certainly not as low as they were 6 months ago.
Excellent. Question online. There's a move led by the US for a global minimum corporate tax. How do you see such a policy affecting the Canada-US economic relationship?
Well, I mean, the US definitely has plans to raise corporate income taxes, certainly for its domestic corporations. And also it wants to raise the minimum tax on its multinational corporations, the minimum amount of tax that they actually pay. So US corporations are going to get hit on both fronts domestically through a possibly a 7 percentage point hike in the corporate income tax rate, which takes them about halfway back to the pre-Trump levels, and puts them a bit over the median corporate tax rate of other countries, and a bit, I believe, a bit above Canada as well as far as effective tax rates. But they're also going to get hit on the global stage. There are the multinational companies operating outside the U.S. And it looks like the U.S. Treasury would like other countries to kind of join that, I shouldn't say party, but kind of face some of the pain as well by raising minimum global income corporate taxes so that tax rates rise for most countries. Remember, corporate income tax rates are really low in some countries, Ireland, for example. So, a lot of the US and other countries don't want too many other countries all moving their operations or headquarters to places like Ireland or other countries with very low corporate tax rate. So we might see something on that front. I don't think it will strain US-Canada relations very much. I think both governments are kind of in sync on the tax front going forward. So.
Great. Okay, one final question. How do climate change policies affect the economy?
Well, it's a question of, I guess, we don't make these climate change policies. What will be the impact on the economy from more severe weather events, for example? But yeah, I mean, there is a cost. And I think everyone admits, companies, governments, and people, that we will have to pay to eventually cushion our economy from some of those adverse effects. Will come at a cost through higher carbon taxes, for example, and just higher costs, generally higher taxes to pay for the transition of our economy from one that's fossil fuel driven to more alternative energy source driven. So, I mean, those costs will be spread out over many years, many generations, but it's a cost I think most people and businesses realize ultimately has to be borne. And perhaps the sooner the better. The important thing is, though, is to make sure that costs are spread out evenly and no one particular sector bears a disproportionate amount of that cost.
Excellent. We actually had one last really good question just popped in that I think we'll just ask, given we've got a little bit of time. Given that Canada's debt to GDP is the highest in the world, how do you feel this impacts our global competitiveness going forward?
Yeah, I don't know if our certainly not our government. Our government debt is not quite the highest in the world. I mean, we're nowhere near Greece, Italy, Japan levels in terms of government debt relative to the size of our economy. Maybe if you're talking all levels of debt, household, non-financial, corporate, and government, yeah, we're probably we're pretty close to the top of the pack. And it's an issue. I mean, for years, governments, economists, policymakers have warned Canadian households to, watch out for the amount of debt that they were racking up at record high levels. Kind of took a breather even before the pandemic. Thankfully, when interest rates were going up, we had slowed our rate of credit growth. And through the pandemic, we've kind of come off a bit as well. But the issue is, if we keep plowing so much money into mortgages, for example, will we start ramping up our household credit again and our debt ratio? So that's an issue. Governments, we already talked about, their debt has just exploded in the past year, and obviously something needs to be done to right that ship. Corporate debt has gone up pretty quickly as well in the last few years in Canada. So, yeah, at some point we have to cool things down. We have to borrow less, live within our means, save a little more, spend a little less, and chip away at that debt. Or ultimately, when interest rates go up, or worse, if we do see a shock to much, causing much higher interest rates, we will pay the piper. And certainly over the next couple of decades, as we try to get our debts under control, it definitely implies slower economic growth than otherwise would be the case if we were not sitting on so much debt.
Excellent. So Sal, I really appreciate you speaking to the club for, I believe, the fifth time, first time by webinar, the previous times all live. It especially helps set the stage for next week's long overdue federal budget. And I'll now hand things over to our host, Barbara Shackleton, to formally thank you on behalf of the club.
Thanks, Steve. On behalf of the Confederation Club, I would sincerely like to thank you, Sal, for taking the time to speak to us about this important topic. We look forward to maybe hosting you again for a sixth time, maybe in person next time. When exiting the webinar, we would appreciate you providing the first 3 digits of your postal code to give us an idea of where you're located. We appreciate your participation. Thank you for joining us. Have a good night.
Thank you.
Thank you, Sal. Thank you, everybody. Good night.
Good night.